A US government shutdown is all but inevitable. What does it mean for the markets? And more importantly, what does it mean for your portfolio? In this video, I'm going to break down the risks, what you need to watch, and the things you can do to protect yourself. If you want to trade this along with me, click on the link in the description below. Let's dive into it. All right, let's dive into the S&P 500 chart. Right now, the futures are down 34 points as we get into this lockdown. Now, overall, the markets have had two very modest drops over the last few days. This is a 4-hour chart, so we're zooming in a little bit. This was the decline back here on Thursday, and what we saw was about a 2% peak to trough correction that occurred. And just today, about a 1% correction. Now, I wanted to specifically reference a JP Morgan report out there that was setting everything up for the lockdown. So what they actually were talking about was historically the S&P 500 would drop about 2.5% going into a lockdown. And then about 10 days into a lockdown, typically we would see about a 2% rebound. And as well, it talked about the types of gains that the market would make after the government shutdown was resolved, and all of them point to markets rallying. And so this is an interesting tidbit of information, but it also is not something that I would anchor too heavily on in this circumstance. And I'll explain why here in a second. First of all, has to be put into context is the magnitude and duration of this rally. To go and say of all of the previous shutdowns that they would only be pulling back, let's say 2.5% going into a lockdown, doesn't put into context how much they have rallied in the prior months, nor how long that rally has lasted. So we have a very unique circumstance where this is, for this decade, the longest and in terms of duration, and also the largest in magnitude rally that we've had without a 5% market correction. 100th percentile on this front. And so the market is in a very overbought state, which changes the dynamic in terms of how much volatility it could experience during a lockdown period. But I will agree in principle that when the market is reacting, let's say, negatively to the lockdown as this pivot, which basically turns around and creates anxiety as to will it be a 10-day, a 15-day, 30-day, 90-day government shutdown, and what economic impacts that may have. Once the government shutdown is released, the market takes a sigh of relief and money naturally will flow back in. So expecting a bullish reaction on the other side of the government shutdown does have merit. But the question here is, because of the magnitude of this rally, could we experience a little bit more gut-wrenching volatility in and during the actual lockdown phase? And that is the thing to watch, in my opinion. So could we have that much anticipated 5+% market correction during a lockdown? It certainly is something that's on the table and entirely possible. And so because of this, you want to step back and think about this from a portfolio perspective. Well, if I just close my eyes and wait on the other side of this lockdown, odds are that any short-term volatility to the downside will be regained in the period after the lockdown is over. And therefore, you can just blindly buy and hold throughout that period. I mean, there's a case to be made for that. But I feel that there's a lot more stress points on it that really warrants the idea of a hedge being a very good way to emotionally manage through this. So imagine the emotion that you may feel if suddenly we had a 1 or a 2% down day in the S&P 500. Let's just say a solid 100+ S&P point pullback in one day. There becomes a strong emotional charge that comes with that kind of selling that makes a lot of investors concerned. Now, to me, the easiest way to manage this is to stay invested in the market is the most logical thing to do on that perspective, but to buy some form of a tail risk insurance that actually emotionally allows you to not get shaken out of any positions if there was one of these shock market moves that usually causes many investors to get rattled very easily. And this is where I love the idea of using a short-term put debit spread to hedge this out. So why is the put debit spread such a powerful tool in this environment? Well, we're not expecting necessarily here a big market crash, not like a liberation day 20% decline. What we're anticipating is short-term volatility, and therefore paying up for an expensive at-the-money put option may be a complete overkill. But at the same time, reducing the volatility and drawdown that you'll experience during a 5 to 10% correction will actually increase your conviction of actually holding through it. So now I was looking at the cost of a put debit spread out till October 17th, going out basically half of a month into this lockdown period. And for an insurance policy that basically kicks in 5% below where the market is and protects you for the next 5% down. So that means it's going to protect you from kicking in at 5% below the market all the way down to 10% below the market. For that, it costs 0.1% in terms of cost, just a minuscule on the SPY, a 60-cent cost. Why is it so cheap for, in this case, a SPY or S&P 500 SPDR ETF, a hedge? Is simply because the skew is so steep on options. I'm not going to go into a deep explanation of it. I'll quickly just show the skew on an options chart. But what I want to simply imply what it means that the short leg of the option is paying such a rich premium, making the total spread very cheap and giving an absolutely amazing risk-reward payoff. This allows you to outlay an incredibly minuscule small amount of capital to have this insurance. And the idea is, well, hopefully I don't even have to use it. Even if the whole thing expires, it was so cheap. Just the fact that it kept you invested throughout that was the value that it paid for itself. And so constructing this kind of a hedge during a lockdown period makes a whole lot of sense, because just like that JP Morgan report was saying, odds are that once the government shutdown is over and their resolution is made, often a relief rally, it does ensue as investors put new money back to work in that environment. And this is why this type of a hedge makes a whole lot of sense. So with this lockdown looming, let's see how this all plays out. Have a good trading day, everyone.